Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. Josh Knoll here, joined by the one and only Michelle Lee Melton, the Martin to my Lewis, the Lucille to my Bob. How you doing today?
Lucille to Bob?
Bob Hope. Yeah, they did a lot of stuff together.
Right? I thought it'd be her and her husband.
Yeah, that would probably be
Dizzy.
Yeah,
or
but
Desi.
I had to do that last minute. So.
Okay.
Well,
I'm busy.
Yes.
Yes.
Good. Well, you mean you have to work outside of this radio show?
I work a lot.
I don't know about that.
Yes.
I don't know about that. Well, yes, you do. And here we are, once again, back in Coastal College's recording studio, beautiful downtown Fairhope, ready to put together another great show for those of you tuning in. So listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, those of you living your best life along our part of the Gulf Coast. Here's what we got in store for you. First segment, deep dive on our topic of the day. Second segment, roughly 20 minutes past the hour, fan favorite, Michelle at the news of the week. Yes, crowd goes wild. Third segment, roughly 40 minutes past the hour, Josh's crystal ball and Big Mouth. That's right. So buckle up. We have got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor, and I hold my FINRA Series 65 securities license. Also, I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope and Orange Beach. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, do not worry. We repeat it several times throughout the show. But so let's
does.
I do. Yeah, let's get on with the show. The title of today's episode is Needle versus Haystack. And it's going to be centered around an investment vehicle that many of you all, if not most of you all, have probably heard of, but maybe you don't fully understand how it works. And that is index funds. And while it may seem that index funds have been around for as long as there's been indexes to track, the actual truth is that the first index fund, which was the Vanguard 500 index fund, was launched in 1976.
Yeah, bicentennial.
Yep, I was 1 year old, and you were just a new, or maybe not even. You might have still been in the oven when it was launched.
Yeah, I was late 76.
Yeah, you were late 76. But so even though actively managed funds have been around for decades longer than these index funds, this past year, index funds caught up with and surpassed actively managed funds. And it's one of the reasons we're talking about today, because it's one has momentum and the other does not have as much momentum. But so let's do this. Why do we call this a needle versus haystack discussion? First, this stems from a famous quote from the father of the index funds, the Vanguard Group, what I just referenced a minute ago. His name is Jack Bogle, and he famously said that instead of trying to find the perfect handful of stocks or needles, if you will, it's much easier for investors to buy just go ahead and buy the entire haystack, right? Now, when Bogle put his theories into play in 1976 with the opening of the Vanguard and the first index fund, what he did, he ended up touching off an investing revolution. I would argue still molds and shapes the entire stock market. And as you will see, some will argue that shaping is for the worst. Some will argue that index funds are the best thing to ever happen to retail investors. As with everything else, we're going to give you some context and some balance. We're also going to discuss all of this, how index funds help pave the way for what's called exchange-traded funds, or ETFs, and how these different types of passive investment vehicles have forever altered the choices in your investment and retirement accounts. I would argue probably way more than you realize. But first, Michelle.
Yes.
As someone that has a 403 retirement plan and your regular job outside of the millions that you make from this radio show, 403B being the public service version of a 401k, do you know if you own any index funds in your plan? I didn't give you much of a heads up.
I do.
Because
you told me.
I did.
That I do.
Well, then let's do. How would you describe an index fund?
They're on those indexes.
Okay,
So the Standard & Poor 500, those other ones, yeah, that's all I got.
that's all you got. Okay, well then let's do this. And because you've, like a lot of typical people that have invested for retirement, you've held various forms of index funds for years, and you may just not realize it, or if you did, you didn't really exactly know what they were. So let's start this with a technical definition pulled from Investopedia on index funds. Okay, are you ready?
I'm ready.
Okay. An index fund is a type of mutual fund or exchange traded fund, again, ETF, with a portfolio constructed to match or track the components of a financial market index, such as S&P 500. That's a very well-known one. An index mutual fund provides broad market exposure, low operating expenses, and low portfolio turnover. Now,
there you go.
There's one more line in this, and I want listeners to pay attention to this last line of the definition. These funds follow their benchmark index regardless of the state of the markets. That means up and down.
Right.
We'll talk more about it later, okay? All right, so, and then to be fair, I know not everyone listening here lives in Nerdville with me, and some of these terms are like, okay, fine, that's a definition, but what does that actually mean? So let's start with the most important part of the index, something that Michelle referenced just a minute ago. The most important part of an index fund is the actual market index that is being tracked. So investors, you all should note, there is literally an index and a corresponding index fund for nearly every financial market in existence. I mean, we're talking about thousands of indexes. So for the sake of brevity, what we're going to do is we're going to talk about some of the more well-known United States-based indexes. First up, we already mentioned it, was the S&P 500. You're familiar with that, Michelle, right?
Yes.
Okay. Another one, it's not as well-known, but it's one of the broader-based ones called the Wilshire 5000 Total Market Index. 5,000 means there's 5,000 positions in that index, so it's a very, very broad-based one.
What, they can't go to 5,000 too? I mean, how does that work?
you got to stop it somewhere, I
Okay.
guess. The next one, now we've talked
What
about
if
this.
it drops to 4,998?
Well, then they'll pick up two more somewhere along the way. This next one we've talked about before on the show because it was down horribly in 2022 when the bond market fell out. The Bloomberg U.S. Aggregate Bond Index, that follows the total bond market, that had a terrible run there for a while back when interest rates were risen very rapidly. There's a NASDAQ Composite Index, and I believe that's 3,000 stocks listed on the NASDAQ. Of course, that's going to be fairly tech-heavy. And then, of course, there's the old Dow Jones Industrial Average. That has just 30 large-cap companies. Okay? So
Nice.
whatever the index being tracked, indexing by definition is a form of passive fund management. What we mean by that is instead of having a fund portfolio manager actively picking stocks or trying to time the market, they instead build a portfolio whose holdings mirror the securities of a particular index. The idea is that by mimicking the index profile, sometimes it's the stock market as a whole, like with that Wilshire. Sometimes it's a specified segment of the market, like with the Dow Jones Industrial Index. Whatever it may be, the fund will also match the performance of its index. By match, we mean that an index fund is neither trying to outperform its index nor underperform.
Just steady Eddie, just whatever it does. Okay.
Thank you. By holding the same securities at the same percentages as this index, it's trying to match the returns within a margin of error that is a fraction of a fraction of a fraction. Mm-hmm. These things try to be as close as they can be. Now, here's why that's important. Contrast that with actively managed mutual funds whose stated goal is to outperform whatever benchmark they are using. Okay. Just matching the performance of your benchmark in an actively managed fund means that you've wasted a whole lot of time and effort. Or if you want a TV or a movie reference, would Gordon Gekko of the Wall Street movie be satisfied with being a passive investor?
Absolutely not.
So you get the idea, right?
Yes.
Not that he was a actively managed mutual fund. He didn't have a mutual fund. He had a hedge fund, but you get the idea. Mm-hmm. So here's the thing. Because index fund managers are simply trying to replicate the performance of their benchmark index, they typically don't need the services of research analysts and definitely not stock pickers. Plus, they tend to buy and sell their holdings less often. So their overall cost should be relatively low. That's one of the key factors of an index fund. Contrast again with actively managed funds. They tend to have larger staffs. They tend to conduct more transaction. And generally speaking, they have a higher cost of doing business. The cost of fund management should be, whether it's passive or active, it should be reflected in the fund's expense ratio. For example, We talked about BIPs on the show before, right? You remember BIPs, Michelle?
Yes.
Cheap index funds can cost just a handful of BIPs, say 5 BIPs. What is 5 BIPs? That's 5%.
Of 1%.
Thank you. Compared to much higher fees in an actively managed fund, that could be 1%, which would be 100 BIPs, right? Plain English, 1%.
Yeah.
Okay. All right. So lastly, there's been quite a bit of research around how index funds have generally outperformed actively managed funds, especially over a longer time horizon. Savvy listeners, some of you all will recognize a bet made by famed investor Warren Buffett. Sometime back in the early 2000s, I want to say 2006 or 7, he bet against some well-known actively managed fund managers. He picked some index fund, and after many years, I think it was 10 years, he ended up beating all of these actively managed funds, right? I don't know the exact, did he whoop them? I have no idea. I'm just telling you that he won. That said, some of the research that blindly supports index funds has been debunked. So let's do this for the sake of brevity, because we could be here all day. You
gotta stop saying brevity unless you mean it.
Okay, that's fair. So let's all agree on this. And by saying agreeing, this is my show, so I'm going to say it, and we're going to agree. By most measures, index funds are a low-cost way for retail investors to gain broad exposure in the stock market or the bond market, and that as long as you believe in the future of America or believe in the future of the global economy, given whatever index you pick, those funds will eventually make some gains over time, coupled with the potential for devastating losses to be tempered by the diversification automatically built into most of these funds.
All right.
Got it?
Okay.
Doesn't mean they're perfect, but it means that you're never going to have all winners at one time. Conversely, you're never going to have all losers at one time.
Right. Variety.
So with all that, everything I just said, Michelle, it sounds pretty appealing, right? Why wouldn't just every single retail investor plow all their money into index funds?
Why? I'm sure you're going to tell us.
Well,
I actually read some articles about it.
Yes, you did. And I think they're pretty good. Just like with any other investment choice you have, there's a trade-off. There's always a trade-off. So you remember in our definition of an index fund that the goal is to hold the securities in nearly the exactly same percentage as the index being tracked.
Yes.
Okay. That is called
waiting.
Thank you. Waiting. Not waiting for the doctor.
In the waiting room. No.
But your wait.
As in LBs.
Yeah, LBs. And the problem with waiting in index funds is that it tends to be a self-fulfilling prophecy where what happens is the market cap of the largest companies get bigger and bigger. Okay. What do I mean by this? Let's use Microsoft as an example. Right now, Microsoft is about 7% of the total value of the S&P 500, okay? The goal of any S&P 500 index fund would be to have the exact same percentage in Microsoft stock. So 7%.
Gotcha.
Right? So fine, numbers match. Why does that matter? Here's why. I want you all to think about it. Listeners, think about this. For every dollar that investors place into an S&P 500 index fund, about 7% of that is going to go to purchase Microsoft stock every time, whether or not Microsoft is a great buy at the moment. What this does, it tends to allocate too much capital when a stock and these indexes are on a tear. For example, NVIDIA, the chip maker, artificial intelligence related, lately it has had a huge run up in the value of its stock, which means its overall percentage of the value in the indexes that it's part of has dramatically increased, which means by definition, millions and millions, probably billions of dollars are now passively flowing into NVIDIA and Microsoft stock without regard to future performance. Not that they're going to go down or anything like that. It's just blindly being plowed into these stocks. Got it?
Yep.
Here's the thing. The phenomenon works the other way too.
All right.
If Microsoft or NVIDIA or any other large corporation takes a big hit to a stock price, and quickly becomes a smaller percentage of the overall stock market, the corresponding index funds will sell these positions quickly to get their weighting back in line, right? And sometimes the volume of these sell activities can make a bad situation that much worse. So listeners, I want you to think about this swinging back and forth. The billions of dollars that are going to buy, the billions of dollars that are getting sold, that goes back and forth every day, especially when you have market volatility, especially when you have huge companies that are huge, trillions of dollars in valuation that are part of these indexes, and a lot of these are growth-oriented tech companies. My question is, do you think there's any correlation to the fact that there's the most money ever right now in passive investments and some of the most historical market volatility over the last couple of years?
Yeah.
It goes hand in hand.
Risky.
It's not risky. It's just volatility.
But still.
But if
you have more risk, then you have more ways and means to be successful, right? Make more money.
Yeah, no risk it, no biscuit.
Yeah, there you go.
We'll expand on that part of the conversation later. The other problem with your classic index fund is that there's no downside protection. That is, if the broad market is down, so will be your index fund. Okay, none of this matters. The pros and cons, we've talked about them, and we're going to dive in more with articles that Michelle has. The bottom line is this: anyone in my industry would agree that passive investing is here to stay. And the fact is that most, if not all of you listening right now own some type of index fund. In fact, I would say whereas historically you have owned an index mutual fund, such as a Vanguard or Fidelity or Schwab, many investors now will hold exchange-traded funds, or ETFs, as their index fund of choice. Index funds walked so ETFs could run. Okay. And here's what I mean by that. The index fund was born in 1976, making it around 47, 48 years old right now. Okay. But the first ETF, exchange traded fund, came about. It was called SPDR,
Spider.
And it's still around. The SPDR S&P 500 ETF, ticker symbol SPY, I think, that tracks the S&P 500. That was established in 1993.
All right.
Yeah, when I graduated high school, a year before you did. So it recently celebrated its now 31st birthday.
Oh.
Index funds are not directly, the index mutual fund is not directly correlated to an exchange traded fund. But again, if you didn't have index funds walking, you wouldn't have ETFs running. So let's do this, Michelle. Let's close our segment by defining what an exchange traded fund. An ETF is a type of pooled investment. It's a security that can be bought and sold much like an individual stock.
All right.
What I mean by pooled, the pool in your backyard? No. What I mean is that's when multiple investors combine their money to buy securities, typically in bulk, right?
Okay.
The main difference between an ETF and a mutual fund is that even though a mutual fund is a pooled investment, just like an ETF, a mutual fund trades only once a day after the stock market closes, whereas an ETF's price will fluctuate throughout
the day, just bouncing all over the place.
Just like a stock, right?
Yeah.
An ETF can be structured to track anything from the price of an individual commodity to a wide variety of securities. And ETFs can also be designed to track specific investment strategies, okay? There's a reason why the first Bitcoin investment tracking vehicle was put together as an ETF, right?
Okay.
Lastly, ETFs are considered more tax efficient than mutual funds. Not going to get into that right now. We'll explore that more in future episodes. So there we have it, a brief history on index funds, who are kind of the daddy, if you will, the parent, the originator,
the OG
spark of exchange traded funds. 1976 leads to 1993, which leads to today, where there is more money going into passively managed investment choices versus actively managed. And so my question to you, Michelle, is what did you learn outside of that?
Index funds are designed to mimic the performance of a specific market index.
That sounds like you're cheating. Well,
I read and wrote that down earlier.
That's good. I like it. It's true. And here's my primary takeaway. The days of stockbrokers and hotshot traders, those days are waning. They've been waning for a long time. And part of the demise can be directly attributed to the rise of index funds and passive investing. Investment management, for better or worse, is slowly becoming a commodity. And for the majority of financial advisors, it differs little to little among them. Now, I personally think our investment management offering at Gulf Coast Financial Advisors is unique. And we will devote an entire episode down the road to describing that in the future. But for now, momentum is clearly favoring passive investing. In my opinion, is that for most of you all that are in or near retirement, when it comes to the investment management piece of what guys and gals like me do, financial advising, the real value is what we bring to the table as financial planners and the actual financial planning process. In fact, I would argue it's just as important as the investment management piece in most situations. Not that the investment management piece isn't significant. A good financial planner should have a solid investment management process. If they can't describe it, that's not good. And for describing it, I cannot wait to share ours with you all in one of our future episodes. But for now, being able to tie together your entire financial picture through a comprehensive financial plan, that is where a lot of the real value is being brought to the table right now. Again, particularly since a lot of the world is moving to passive investment. And on that note, if you all are interested in have that conversation, How our approach works at Gulf Coast Financial Advisors. Our goal is to educate and enlighten. We do that through personal interaction, also through the radio show and some of the other stuff we do online. And when we do schedule meetings with folks, definitely the first meeting, we've talked about many times on the radio show, there's never any pressure to make quick decisions. Or do any business till you're comfortable with this. If you're talking about the rest of your life, being forced to sign on the dotted line after an hour of talking seems a little much, right, Michelle?
Yes.
Right. So if you're interested in having that conversation, that initial conversation, no pressure, no BS, just give us a call, 251-327-2124, or you can reach us through our website, gulfcoastfa.com. Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. Now on our site, you can send us a direct message. You can click on the blue button in the upper right-hand corner. That will put a 15-minute introductory phone call on my calendar. Or again, you can just call us, 251-327-2124. And to Michelle's delight, I actually answered the phone. It's kind of fun, right?
And except for when movies, that irritates people.
That's fair. Yeah, if you hear noise in the background, you caught me doing something. But that's okay. I want to know if the show is reaching people, and it is.
Yay.
So, all right. Well, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. So every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, particularly articles that pertain to those of you in or near retirement. So join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting Retirement. Your host, Josh Null here. So as we discussed before the break, every week, Michelle and I scour the interwebs for financial articles related to our topic of the day, special articles that pertain to those of you in or near retirement. Our job is to help you all understand how these headlines impact you, especially when it comes to your money. Now, a quick note for the listeners, if you want to read these articles that we reference, we include the links on our show transcript, which we put up on our website the Monday after the show airs on Sunday, gulfcoastfa.com. Just look under the podcast tab. So with all that said, and without further ado, here's Michelle with the news of the week.
Okay, Josh, let's kick it off with an article from Morningstar, not the veggie burger. But Morningstar has an article titled, "Nobody Likes Index Funds Except Investors."
Okay.
This article is written by an obvious fan of index fund, naming them in something called a target date fund as the two best mutual fund inventions ever.
Okay. Strong words.
Right. I had obviously heard of index funds, learned more about them in the first segment as well. But until I read this article, I did not realize that there was such a political divide over them. So we intentionally do not discuss politics or religion on the show for obvious reasons. Mm-hmm. Nobody wins. But I must say that the fact this article mentioned a white paper circulating out on the interwebs and in the universe titled "The Silent Road to Serfdom: Why Passive Investing is Worse Than Marxism." Whoa. Heavy.
That's heavy.
Who knew?
That is some clickbait right there.
Yes. Well, I clicked. Guilty. I got the free dangling lunch, whatever. I did it. So what's going on here? How is something called passive, which seems pretty benign, result in aggressive words from both sides of the political divide.
Well, I know, right? I mean,
Man.
So let me do this. Before we get into the division of opinions on index funds, you mentioned something called target date funds, right?
Yes, don't know.
Now, just like with exchange-traded funds, we're going to discuss these types of investments in greater detail on a later episode, either the next episode or the one after. So for now, let's just define them quickly for the listeners that are curious.
Please.
And plus, also, too, I believe it ties into our show because, again, target date funds are kind of offshoots, or call them second cousins of index funds. Target date funds, or TDFs, because everything has an abbreviation in my line of work, they're kind of like a small self-contained diversified portfolio. They mix equities and fixed income or bonds into one fund, one self-contained fund. It's designed to have, what the fund is designed to do is take more risk the further someone is away from their retirement date, gradually getting more conservative as the investor nears retirement. I would say that many of you all listening to the show right now, if you have a 401k or 403b at work, you probably hold some type of target date fund. Nothing wrong with it. If you want,
so I have one.
More likely than not.
Okay.
You probably have some index funds. You probably have target date funds.
All
okay.
right.
You can check. An easy way to figure out if you have a target date fund.
Does it have a date in it?
It has
in
a
the
date.
title?
It has a date usually at the end of the fund name.
Okay.
It'll say 2030 or 2035 or 2050.
What does that mean?
That's a year. That's the year
I know,
2030.
but what happens then?
Well, it's supposed to be the year that you aim to retire.
Oh.
And what happens, the target date fund will rebalance itself to get more
2030.
conservative as you get closer to that date. Yeah, that's not very far down the road.
No.
You might be 2060. I'll be 2090.
2060?
I'll be like 1 year away from death, and then I'll retire.
Ew.
I'm just kidding.
You'll be 2060,
That's
maybe,
right.
not me.
That's right. All right. So now, speaking of conservative with the target date funds, you're right. Index funds have critics along political lines. Although I will say, to be fair, in this case, neither political side is a huge fan, at least among the most vocal critics, right?
Okay.
Those on the left say that index funds decrease competition and can lead to cartel-like decisions.
Oh, wow.
among
Cartel,
competitors.
another big word.
Right.
Strong word.
The right says that company profits are held back because index funds tend to promote ESG values, that is, environmental, social, and governance principles. I'm going to be honest with you all, with you and the listeners, and maybe it's because I ignore most news, particularly political news. I read a lot of news. I just don't listen to a lot of news. I'm not sure I agree with either of these points. I think we touched on this on the opening segment, Michelle, but what investors need to watch out for in index funds, outside of the cartels and the ESG, is that if you over-rely on index funds, you'll end up being, by definition, average at best. And for those of you in or near retirement, some index funds are going to have you way overweighted in stocks with heavy volatility. Remember we were talking about earlier with NVIDIA? NVIDIA has a lot of fluctuation in the stock price. Now, right now, things are great, but NVIDIA could get some very bad news, and you're talking about something that has billions and billions, trillions now dollars of market cap. It doesn't take a lot of heavy movement in that the stock drops 10%. That has a huge effect on your index fund. On that note, we have a program we actually use at Gulf Coast Financial Advisors. It's called Riskalyze. You other financial advisors listening are probably familiar with it. And what that can do is perform kind of an MRI on your holdings.
Oh.
That will not only tell you how much money you have or how your money is invested in the different segments and industries, it'll also, and actually drill it all the way down into how much you have in tech and things like that. It's also going to give you a risk score, which we can then compare that to your actual risk tolerance. I can tell you, and I'm doing this many years, I've only seen the Riskalyze number match the client's actual risk score one time.
Really?
It's usually out of whack.
It's not encouraging.
It's just because a lot of times these portfolios are designed blindly.
Oh.
They're not tailored to the individual investor.
Well, all right.
A lot of times when people are conservative, they have a very aggressive portfolio. And sometimes when people are really aggressive, they're holding half in bonds, and you're like, okay,
So
you
it
haven't
takes
been
forever.
getting very good advice here. Let's, I like your plan, but your plan sucks. Let's talk about my plan. 251-327-2124 if you want to have that Riskalyze
Let
analysis.
Josh talk about your plan.
That's right. We do it free. So just let me know you're calling from the show for the free, okay? All right, what's next?
So when you told me the title of this episode was Needle versus Haystack, I wondered if you had come up with that clever investing comparison all on your own. You did not.
Nope.
You were just parroting a phrase made by the aforementioned famous index fund pioneer Jack Bogle, I wonder if they started Bogle Wines. He made money with Vanguard and like bought some vineyards.
That's a good question. I don't
know we
think
need to look
so.
that up,
but maybe it's a family member. All right, keep going. Sorry.
Okay. So I also learned that when I did a search on the interwebs, I was able to find an article titled How to Invest. Forget the Needle by the Haystack from a site we haven't referenced before called the Fair Observer. Which, if we still had a newspaper in Fairhope,
might be a good name.
I thought so too.
I like it.
Okay, so as opposed to our first two articles, the article leans heavy into statistics. It's long.
Yes,
and there's a lot of numbers, and it kind of makes my little gnat brain hurt. But anyway, so it leans heavy into statistics to lay out the pros and cons of index funds. The article talks about one potential downfall, something we've discussed on the show many times, the fact that the Magnificent Seven stocks are currently a very large percentage of the S&P 500. And only one of them's doing well right now, I think. I mean, they're all doing well.
Everything's doing yeah.
But then there's one that stood out.
There's one that's shooting the moon right now.
Yeah. Okay, and for index investors, this means that they're going to be heavily invested in technology stocks, precisely when the sector commands historically high valuations. So again, so much debate over something that is considered a very vanilla investment choice. Did not know there was so much controversy.
Right.
What are your thoughts on this article?
Well, so this article is for those of you listening that like to know how the sausage is made. Michelle's right. It's got a lot of statistics. It's pretty fair, pretty balanced. I enjoyed it, obviously, because I'm a nerd.
I have a sidebar. I forgot. I wrote a note about this. So we had to play the stock market game in high school economics, right?
Right.
And I picked Hanson Natural as one of mine. I did not know it turned into Monster because I love the juice. You know how I like the juices, the fresh juices.
Yes.
And so Hanson made great sodas and juice. I guess they still do.
Well, so I'm jumping ahead. You're stealing my thunder a little bit.
No.
Did you know that?
I did not mean to do that.
No, but this is great. It's a great segue, and then I'll come back to my main point. The Monster, the parent company of Monster Energy Drink. Do you know what's been the greatest performing stock over this time period? I think it was 1995 to 2022. Do you know it's been
apple juice?
Monster, the company that owns Monster. It's like an 800% return. I mean, it's better than an apple. So
really?
If you had bought, so here's the point, Michelle.
Well, we did in make-believe land in high school.
If you had actually bought it and held it.
I saw those numbers.
Oh my gosh.
I know, right?
Oh, now we're
Jan Dukes, which she rest in peace. She was like, "What is this stock?" I'm like, and I had to bring cans and show them to people.
That would have been. We'll have to. I tell you what, listeners, tune in next week and we'll figure out how much Michelle
Maybe we should play the stock market
Michelle
game.
left on the table by not buying and holding. Hanson was the originator of Monster.
Yes.
Yeah, we'll find out. We'll get some real numbers.
They still make natural flavored sodas and juices.
Now, okay, so back to my main point. Regular listeners to the show, you'll recognize the Magnificent Seven reference that Michelle just made. No, it's not the Western movie starring Yul Brynner, one of my all-time favorites. It's actually a list of companies. It's Alphabet, which is Google, Meta, which is Facebook, Nvidia, Tesla, Microsoft, Apple, and Amazon. Those 7 companies have driven most of the growth in the stock market the past few years. And what that means, for those of you all that have what's called fear of missing out, where you feel like you're missing out. Yeah, FOMO, where you feel like you're missing out on a great investment. Here's the thing. I mean, kind of take a step back. If you own an index fund, or at least you have an index fund that tracks one of the big U.S.-based indexes, then you undoubtedly have some type of position in these companies, probably all 7 of them, right? So if you're concerned, like, man, I missed the boat on Tesla or Microsoft or any of those, if you had an index fund, chances are you didn't. You just didn't participate fully in the rise, but you at least had some percentage in those companies, right? Mm-hmm. That's a great way to walk people through FOMO when they feel like they should plow everything into one stock. You're actually, with how indexing works in modern investing, you actually are owning some of these companies that are doing well. Now, conversely, you're also owning some companies that do terrible. But if you're an investor with a heavy dose of index funds in your portfolio, again, back to that risk-realized analysis, you're going to be probably surprised, for better or worse, how high a percentage of your positions in these companies, how much that comprises your overall portfolio value. It is an eye-opener, and it's fun. Now, this along that line, Michelle, this is back to what you were saying. This article details, and I'm quoting, the top heavy weighting in index funds isn't new. Between 1995 and 2022, only 10 stocks, which is just 2% of 500, if I do the math, accounted for at least 1/5 of the performance of the S&P 500. In some years, the top 10 stocks provided more than 100% of the gains of the index performance. That means that if you exclude these 10 different stocks, and they weren't the same 10 every year, but they tended to be fairly consistent. But if you excluded them from 1995, you took out the top 10 every year. Between 1995 and 2022, the S&P would have had a negative return. That is I find that fascinating. And I also find it fascinating that Monster, the company that became Monster, outperformed everybody.
Monster energy drinks. Does that mean that's what it is, right?
I think that feels like what
no,
was
Monster beverage. Yes,
I feel like what was one of the signs of the decline of civilization? Well, Monster drinks were the best thing ever, right?
Well, there's the water company that's liquid death.
No wonder we have so many kidney and liver problems. All right, get off my soapbox.
All right.
We got time for one more?
We do. Okay, so last article coming to you from CNBC Business with an absurdly long title.
All right, get ready.
The first ETF is 30 years old this week. Or maybe is it 31? Anyway.
Well, the article's about a year old, but
okay.
I helped you find that one. It's a good one, even though it's a little outdated.
It launched a revolution in low-cost investing. Even though this article is about a year old, we just discussed that, I thought it was useful to include because it gave a solid and concise history of ETFs and no political drama mentioned. According to the author, ETF assets are doubling roughly every 5 years. Apparently, there were only about 80 ETFs in the year 2000, but by January 2023, there was over 2,700.
I bet
and
we're
that's
north
just within
of,
the United States.
I bet we're 3,000, 3,500 now, somewhere in that
range. All right,
range.
is that a prediction or something?
Yes. Yeah, that's right. Write it down. We'll see if my big mouth's right.
What'd you say?
Yeah, probably now. I bet there's that many more ETFs sprung up over this last year. And I'm still in your thunder,
and that's
but
just
I believe
in the U.S.
Right. Yes.
Yep. So it makes the case that while the mutual fund history is still significantly larger than the ETF industry because it's older, the growth rate is much higher with ETFs and the gap is closing. I'm curious about your stance on ETFs. Plus, do you agree with the quote in the article that ETFs are, quote, the one product regulators trust because of its transparency, unquote?
Well, okay, again, I think the rise of ETFs, exchange traded funds, that since I graduated high school, 1993, that's when the first ETF was released. I think the rise of them since then, one, it makes me feel incredibly old, but it also it's incredible. And again, we've talked about it at length. I know Jack Bogle did not invent ETFs. He invented index funds, but his index funds were the evolutionary step that eventually led to ETFs.
They birthed ETFs.
That's fair, I think. And we got some ETF guys we're going to bring on the show here in the next couple of weeks, and we'll put that to them and see if they agree. I think it's fair to say more people know Warren Buffett and Steve Jobs, but I would argue Bogle's impact on retail investors way more significant than just about anybody else in our modern era of investing. So let's describe a couple areas where, back to ETFs, where people think ETFs are superior or have an advantage to actively managed mutual funds. One, ETFs, as we discussed earlier, ETFs can be traded all day long, just like a stock. It's going to have a constantly updated price versus with a mutual fund, you got to wait until the market closes to see what the price was. Number two, most ETFs have no minimum investment threshold. Now, a lot of index mutual funds don't have any threshold either, but that's a key feature. Three, most ETFs have lower fees than their equivalent mutual fund. And then four, there is some built-in tax efficiency in ETFs that mutual funds don't have. Again, we'll describe that more on an upcoming episode. The transparency quote, Michelle, that revolves around the fact that some actively managed mutual funds keep their holdings close to the vest. I would hazard a guess for competitive reasons, right?
Right.
While ETFs tend to be a little bit easier to figure out what's contained in them.
Okay.
I will tell you another thing that has made ETFs popular with both investors and advisors like me is that a lot of trading custodial platforms like Charles Schwab will let investors and advisors trade stocks and ETFs with no transaction fees.
Okay.
As a contrast to mutual funds, which it's small, but there's still a transaction fee. And then lastly, there's just a lot of cool things going on with ETFs right now. In fact, as you and I when we watch some TV shows, there's commercials for actively managed ETFs, which, as the listeners have learned through this episode, is kind of a oxymoron, but that's what it's going to, actively manage ETFs. We don't have time to discuss now. We're going to put a pin in it, circle back in the next couple episodes. There's a lot going on with ETFs. So lastly on this, though, Michelle, I will say, though, as the bad guy in the incredible superhero cartoon movie said, the flip side of passive investing is that if everyone's special, then no one is special, right? And as we've discussed during this episode, going full tilt into all passive investing leaves you both exposed to having no better than average returns, possibly, and probably more volatility, more up and down than most retirees would like to see in their investment portfolio. So as with everything, there is a balance. So if you'd like to discuss how to find that balance, give us a call, 251-327-2124. Is that it?
Yeah, I want some ETFs.
You have, I promise you.
Okay.
We'll bring your statement out. So first we'll figure out how many
I got my
millions.
Charles Schwab statement today, too.
We'll figure out how many millions you left on the table by not buying
Hanson.
Hansel. He's so hot, Hansel. And
so
then
hot right
and
now.
then we'll see what kind of, see if you got index funds, target date funds, and all this. This is it's good stuff to know because you need to know what you got in your investment
Heck
accounts.
yeah.
So, but anyway, great job with the headlines, important pieces of information. Now, listeners, if you have questions around the topics in our headlines of the week or just questions related to your investment strategy or your financial plan, again, give us a call, 251-327-2124. Happy to have a conversation. Happy to set up an appointment. Again, also, you can also reach us on our contact page on our website, GulfCoastFA.com. Gulf like the Gulf of Mexico, Coast, FA as in financialadvisor.com. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong?
Sometimes.
How wrong?
Depends.
I don't know about that. Well, what do I think is going to affect investors in the near future or maybe even the distant future? We get to talk about all these things, plus poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at GulfCoastFA.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host Josh Knoll here, alongside co-host Michelle.
Howdy.
So I'm opinionated.
No.
I do. I have strong opinions at times. I would say, in my defense, a radio show host that isn't
Would be a snooze
opinionated,
fest.
it would not be very interesting to listen to. Of course, I'm paid in my profession to offer professional guidance and opinions to my clients. Again, otherwise, what use would I be? So now sometimes I feel so strongly about something, I talk about it publicly. And sometimes, even though I tend to be skeptical about my own industry, some of my predictions and my big mouth was wrong. And I do swing and miss. So if you want to hear me eat a little crow, let's get at it with Josh's crystal ball and big mouth. What you got first?
All right, Josh. Back in June of last year, we did an episode on meme stocks. One of the stocks we discussed was EV manufacturer Rivian, which you have a soft spot for.
I do.
So at the time, Rivian had about 25% of the market capitalization of legacy automaker Ford, even though it had only delivered a handful of its SUV and trucks to buyers at that time. We use Rivian as an example, not of a bad or good company, but just how out of whack stock market valuations can be compared to the underlying financials, at least in the short run. Rivian did end up delivering over 5,000 vehicles last year, but its stock has still sank over 50% in value recently because of decreased demand projections and the miserable fact that apparently Rivian lost over $40,000 on every vehicle it sold last year.
Crazy.
Not sustainable.
Right.
As of this recording, Rivian will have unveiled its much more affordable R2 vehicles, which most analysts say is crucial to Rivian's ability to survive. What's your big mouth got to say about Rivian now?
Well, so the reason we brought them up again was not to pick on Rivian themselves. I think Rivian, we've talked about this. Apparently the guy that runs it, everything I've seen, the guy's brilliant, right? I mean, he's legit. He was an engineer. He's not some fluke. He's not just some fly-by-night guy that gathered a bunch of money.
Cars are expensive to make.
Cars are horribly expensive to make. Rivian, we've seen some here around Fairhope. And, right? They look good. Mm-hmm. By all accounts, they build a nice car. So that's not the point. The point was, at the time, Rivian was worth, I think, 12, it was $12 billion. Ford was only worth maybe $50 billion. And that's crazy when you look at the difference in fundamentals. Ford's revenue, Ford's profit, forget the total revenue, drastically dwarfed, wasn't even close to Rivian's entire gross revenue. So it's one of the things, the point of it, including of this episode, is I don't know if Rivian's going to make it or not. I just know that when you're looking at valuating these things, yes, you are factoring in future hope and projections. I mean, the people that took a chance on Tesla ended up fine. Yeah. And that's really what this is. People think Rivian is the truck and SUV version of Tesla. Maybe they're right, maybe they're wrong. But the point is, it comes back to, are you looking for the needle or are you looking for the haystack? The point of it is, fine if you got some exposure to companies like Rivian, but if you have overexposure in this, if you're all needles and you're not haystack, again, there's a balance. We need to take a look at your portfolio and have a conversation. Very good. What's next?
Well, it's not Halloween, but it's our favorite subject, the Michael Myers of investing. And I guess that means it as a compliment, but I'm not sure. What's going to kill the Michael Myers at this point, which is...
You must be talking about...
Crypto,
right?
Right, specifically
yes.
Bitcoin.
Okay.
New listeners, if you want our opinion on crypto, please binge some of the previous radio show episodes found on Josh's website. However, to sum up, we've tried to be fair, but Josh and I have become even more skeptical the deeper we dive into crypto.
Yes.
With that said, here's some recent news about crypto, Josh. Bitcoin prices broke its previous record this week, rising above $69,000, topping its previous peak in November of 2021.
Right.
So the crypto bro you mentioned, he's ecstatic. He's
ecstatic.
Going crazy.
Crypto bro's going crazy.
Right. And now to say that demand from recently approved spot ETFs, holla, is fueling much of this demand. Now, of course, the price of Bitcoin fell over 3% almost immediately after hitting this high. Wah, wah. But hey, what's a little volatility hurt when the future of everything is crypto, according to the universe? Just kidding.
I would imagine you're kidding.
I jest. But I am serious to know what your crystal ball has to say about this, because to be fair, we didn't foresee a resurgence like this.
Well, it's funny, Michelle. Yes, we have been critical, and there are just certain things that I hold in place that it's going to be hard pressed for anybody to convince me otherwise. Again, what is the everyday use case for crypto? You're not going to be able to use it as a currency. Even Bitcoin, the most established, fluctuates too rapidly up and down for it to be a serious use of currency. And that would be even if you could get a serious, sovereign, strong nation to accept its private citizens printing their own currency. Good luck with that. People say, well, there's all these projects going on. There has yet to have been a project where even the underlying blockchain on a mass scale, retail users, everyday users, nothing has come out to where it's been like, hey, this thing has dramatically increased this XYZ process. Okay. Now, to be fair, I think I'd be better pressed to look at this from an online gambling or gambling in general standpoint. Here's what I mean by that. Everybody with any common sense knows that the house wins over time.
Yes.
Everybody. And if you don't, you're what's called a degenerate gambler. Vegas was not built on you walking away with the money.
I had another word in mind, but anyway, it wasn't that.
Yeah, if you believe that you can beat the house, maybe you can with games of skill, but I'm talking about just broad gambling, right?
Even then, no.
And even the guys, and listen, what is it? I don't, as listeners can tell, I don't gamble. I feel like I take enough risk in the entrepreneurial things I've done to not, mess with the money that I make from it. But sites like FanDuel, which is really heavy on gambling on the NFL, right?
Yeah.
Again, most people there's a reason FanDuel and companies like that are growing exponentially. Is not because their users are winning. It's because their users are losing. Yet these things still tend to be popular, extremely popular. I would hazard a guess. I would love somebody to do a study. What percentage of people that are heavy into crypto are also heavy into online gambling? Because I'm going to take a guess that the two have more correlation. And if Crypto Bro, if you're squirming a little bit right now, I want to know, am I right? Because I don't do either. I don't do crypto and I don't do online gambling. I think that there's a similar mindset there. And so, yeah, it's going up because more people are pumping it into. And same with gambling. They're pumping it into and they don't necessarily care what the outcome is. They just want to, they want to have a chance at a greater payout. And they're worth, and they're at least the ones that are semi-savvy know that there's a risk. My heartburn's always been, more often than not, whether it's gambling, whether it's crypto, whether it's anything where it's a scenario of what the musical chairs type of gambling, what I call it, the greater fool of gambling. It's usually the more less educated in financial means retail investors get left holding the bag, and that pisses me off, to be frank. So there you go. All
okay.
right. One more.
Okay, last one. On a recent episode of our show, we detailed how there were nearly $1 trillion in commercial real estate loans maturing this year, and that those loans will undoubtedly be refinanced into a much higher interest rate environment. Boo. You stated that investors should absolutely pay attention to this, particularly with the effects on regional banks. Looks like your crystal ball nailed this one. Because over the past several days, a bank called New York Community Bank, or NYCB for short, has experienced a severe decline in the price of its stock, as well as customers pulling over $6 billion in deposits. Ruh-roh.
Mm-hmm.
I've seen this movie.
Right.
Apparently, the trouble began when NYCB reported a surprise huge fourth quarter loss that was tied to loans, one on an office property and the other a multifamily property deal.
These must be huge,
huge
projects, right?
Way big than what we have. Okay. And get this, Josh. Remember one of the banks that failed last year? Because there were a few.
Signature Bank.
Signature Bank is right. Guess who bought a lot of the stinker Signature Bank's assets?
I would guess.
NYCB.
NYCB. I'll be danged. Oh, my goodness.
So, what's your crystal ball got to say
tangled
about
web we read.
It's right. It's tainted.
Well, this is absolutely, we're running short on time, so I'm going to be quick with this. Retail investors, particularly those of y'all that hold REITs, and if those real estate investment trusts, if those REITs are heavily concentrated in commercial real estate, we need to have a conversation. There is absolutely a ticking time bomb going on in commercial real estate related to the refinancing of loans. Because what happens, Michelle, is it's an echo of the COVID effect. There's simply less people working in these buildings.
Right. They're vacant.
And what they do, because again, a lot of these deals are set up with the paper thin margins of error that with companies that do things to protect the mothership. When someone tells you that Trump went bankrupt 4 times, Trump himself has never gone bankrupt, but he's had 4 related companies related to his casino industry go bankrupt. Similar to these things, these guys are willing to walk away and let these loans, these guys and gals are willing to let these loans default. They're willing to sell these things at a huge loss. And they don't necessarily care what happens to the investors that are tied into it. And you all need to be aware of that. This is a very cutthroat part of the industry that can have a ripple effect. And I am alarmed because the regional banks are the ones that have the most exposure on these loans. So it's going to be see how this plays out with NYCB. Is it yet another domino? Time will tell, and we'll see with my big mouth and crystal ball on our next episode. Well, listeners, I hope you enjoyed a peek behind the curtain, how I form my opinions and predictions. And more importantly, I'm willing to admit when I'm wrong, which hopefully isn't very often. But now, to our listeners that have more questions around the various investments and topics that we discuss on this show, we invite you one last time to reach out to us. Call us anytime, 251-327-2124. And I told you, Michelle, I had 2 calls last Sunday.
Yes.
Yeah, which was cool.
Yeah,
I enjoyed
cool.
it. Yeah.
Thank you, guys.
Thank you very much. You can call that number, talk to me, make an appointment, or on our website, gulfcoastfa.com. You can message us directly there, or you can find the Calendly link, upper right-hand corner, blue, click that. That'll put something on my calendar, have a 15-minute, no-obligation conversation. So, folks, that's it. Again, here this week in Coastal Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton.
Very welcome.
Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music. That's local band Sloth Racer. A huge thank you to the show producer, Mr. Chazare Gray. And as always, my sincere appreciation for those of you out there that have been listening and joining us on this journey. We'd love to be part of your financial journey as well. So, till we talk again next week, have a wonderful and productive week. This has been Coastal Retirement with Josh Noel.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.